Thank you, Paul, and good morning. I'm very pleased to be here with Senior Deputy Governor Carolyn Rogers to discuss our monetary policy report and today's policy decision. Today, we lowered the policy rate by 50 basis points. This is our fourth consecutive decrease since June and brings our policy rate to 3.75%. We took a bigger step today because inflation is now back to the 2% target, and we want to keep it close to the target. Aujourd'hui, on a abaissé nos taux d'intérêt de 50 points de base. Cette quatrième baisse consécutive depuis juin fait passer le taux directeur à 3,75%. On a fait une plus grosse réduction aujourd'hui parce que l'inflation est de retour à 2% et on veut qu'elle reste près de la cible. In the past few months, inflation has come down significantly from 2.7% in June to 1.6% in September. Recent indicators suggest it'll be around 2% in October. Price pressures are no longer broad-based, and both our measures of core inflation are now below 2.5%. Our surveys also find that businesses and consumer expectations of inflation have shifted down and are nearing normal. All this suggests we are back to low inflation. This is good news for Canadians. Now our focus is to maintain low, stable inflation. We need to stick the landing. Tout ça indique qu'on est revenu à un climat de basse inflation. C'est une bonne nouvelle pour tout le monde au pays. On a réussi à faire baisser l'inflation et maintenant notre objectif est de la stabiliser. Sticking the landing means the upward and downward forces on inflation need to balance out. Household spending and business investment have picked up this year but remain soft. This softness has helped take the remaining steam out of inflation. But with inflation back to 2%, we want to see growth strengthen. Today's interest rate decision should contribute to a pickup in demand. The bank forecasts inflation will remain close to the target over the projection horizon. The upward pressure from shelter and other services is expected to gradually diminish. With stronger demand, the downward pressure on inflation is also forecast to dissipate, keeping the upward and downward forces roughly in balance. If the economy evolves broadly in line with this forecast, we anticipate cutting our policy rate further to support demand and keep inflation on target. The timing and pace of further interest rate cuts will depend on incoming information and our assessment of its implications for the inflation outlook. And as we've been doing, we will take our monetary policy decisions one at a time. Si l'économie évolue généralement comme prévu, on s'attend à réduire encore le taux directeur pour soutenir la demande et garder l'inflation à la cible. Le moment et le rythme de toute autre réduction seront guidés par les nouvelles informations qu'on recevra et notre évaluation de leurs implications pour les perspectives d'inflation. Et on va continuer de prendre nos décisions de politique monétaire une à la fois. Let me expand on what we're seeing in the economy and how that played into our deliberations. After stalling in the second half of last year, the economy grew by about 2% in the first half of this year, and we expect growth of about 1.75% in the second half. The economy remains in excess supply, and the labor market is soft. The unemployment rate was 6.5% in September. Job layoffs have remained modest, but business hiring has been weak, which has particularly affected young people and newcomers to Canada. Simply put, the number of workers has increased faster than the number of jobs. Looking ahead, GDP growth is forecast to gradually strengthen to around 2% in 2025 and 2.25% in 2026, supported by lower interest rates. This forecast largely reflects the net effect of a gradual pickup in consumer spending per person and slower population growth. We also expect growth in residential investment to rise as strong demand for housing lifts sales and spending on renovations. Business investment is expected to strengthen as demand picks up, and exports should remain strong, supported by robust demand in the United States. The decline in inflation in recent months reflects the combined effects of lower global oil prices, slightly lower shelter price inflation in Canada, and lower prices for many consumer goods like cars and clothes. Going forward, we can expect to continue to see some monthly fluctuation in inflation, but overall inflation is expected to remain close to target over the projection horizon, as upward pressure from shelter and other services gradually diminishes and excess supply in the economy is absorbed. There are risks around this inflation outlook. The biggest downside risk to inflation is that it could take longer than anticipated for household spending and business investment to pick up. Our recent surveys suggest businesses expect subdued sales and their hiring and investment plans are modest. On the upside, lower interest rates could fuel a stronger rebound in housing activity, or wage growth could remain elevated relative to productivity. There's also elevated geopolitical uncertainty and risks of new shocks. Overall, we view the risks around our inflation forecast as reasonably balanced. And with inflation back to 2%, we are now equally concerned about inflation coming in higher or lower than expected. The economy functions well when inflation is around 2%. Let me conclude. L'inflation et les taux d'intérêt élevés ont été un lourd fardeau pour les Canadiennes et les Canadiens. Le retour à la cible de l'inflation et la diminution continue des taux d'intérêt devraient permettre aux familles, aux entreprises et aux collectivités de respirer un peu mieux. La Banque s'engage à maintenir la stabilité des prix pour la population canadienne, en garder l'inflation près de la cible de 2%. High inflation and interest rates have been a heavy burden for Canadians. With inflation now back to target and interest rates continuing to come down, families, businesses, and communities should feel some relief. The bank is committed to maintaining price stability for Canadians and keeping inflation close to the 2% target. With that summary, the Senior Deputy Governor and I would be very pleased to take your questions.
Thank you, Governor. I'll just quickly go over the ground rules here. I've got reporters here in the room in Ottawa. I've got a couple on the line. I'm going to start here in the room. As usual, we'll ask people to limit yourself to one question so we can get to every media outlet. If I somehow forget to do so, please state your name and affiliation. And for those who are new here, please press the green button in front of you to activate your microphone, and then again to shut it off once you're done asking your question. Okay, we'll start here with questions at the back. I'll go to Pramit Mukherjee from Thomson Reuters, please.
Oh, sorry. Thank you, Paul. Good morning, Governor. Wanted to ask you that how fast do you think that the monetary policy, the policy rate should move back to a place where it is no more restrictive? Because clearly a restrictive monetary policy is still taking a toll on the economy.
Look, I mean, since we began cutting rates in June, we've been very clear about the direction. We've also been clear we're going to take our decisions one meeting at a time based on the best available information. So today, we decided to cut the policy rate by 50 basis points, so we took a bigger step. And that really reflected the fact that the information we've received in the last 2 months suggested it was appropriate to take a bigger step. So what is that information that we particularly focused on? I mean, first, obviously, inflation. Headline inflation has come down significantly. Yes, part of that is global oil prices. You saw a big decline, particularly in gasoline prices, and that can be volatile. But if you look beyond that, there are some more fundamental factors. Core inflation has continued to gradually ease, largely as we expected. If you look at shelter price inflation, it's still elevated, but it has started to come off, and that has increased our confidence that will gradually continue to ease. we've still got excess supply in the economy. Labor market's still soft. You are seeing, the excess supply in the economy is putting downward pressure on many goods and services prices. You're seeing that particularly in consumer goods prices, which have been quite soft. And if you look at expected inflation, our own surveys of inflation perceptions, consumer and businesses' expectations of inflation have come down and are now nearing normal. If you look at the economy, it's growing, but the economy continues to be in excess supply. The labor market is soft. Our growth forecast hasn't changed a great deal, but we have revised down near-term growth a little. So you put all that together, to us, that suggested it was appropriate to take a bigger step today. So that's what we did. We've also indicated that if the economy continues to evolve broadly in line with our forecast, we do anticipate further cuts in our policy rate. And as I said, we're going to continue to take those one at a time based on the best available information. Our focus now is very much on keeping inflation close to the target. There's going to be some fluctuations. There inevitably will be some month-to-month fluctuations. We're focused on keeping it close to the middle of the 1% to 3% range. So, what does that mean? It means as the upward forces on inflation ease, we need demand to strengthen, take up the slack. In terms of the data, we're going to be particularly focused on between now and December. Look, I think it's both inflation and growth. We're going to get the third quarter national accounts. We're going to get a couple of employment reports. We're going to get a CPI release. So we'll be looking at all that data as well as any other information we receive between now and then, and we'll take our decision in December.
Okay, thanks. Next, I'll come over here to Mark Rendell from the Globe and Mail, please.
Thanks for taking the question. I'm wondering, at the Governing Council table, how much discussion was there of a 25 basis point versus 50 basis point move? And was there any discussion of an even larger cut, given that rates are still restrictive, inflation is back on target, and you want growth to pick up?
Mark, look, we had a good discussion. We always chew through the alternatives, but what I can tell you is, look, there was a clear consensus that it was appropriate to take a larger step today, cut 50 basis points. In response to the previous question, I really outlined, what we saw in the recent data and what that led us. Why that led us to cut 50 basis points today. There was also broad agreement that if the economy continues to evolve broadly in line with our forecast, that we expect we'll be cutting rates again. We'll be cutting rates further. We will continue to watch the data as it comes out relative to our forecast, and we'll take those decisions one at a time. You'll get the summary of deliberations in a couple of weeks, and you'll get a little more color around that. But yeah, I think the bottom line is there was a clear consensus that it was appropriate to do 50 today, and that's what we've done.
Okay, next I'm going to come over here to Randy Thantong-Knight from Bloomberg, please.
Hi. The bank has said that it would keep QT going as long as they're cutting for normalization, but 50 basis point cuts aren't really typical of normalization. Does this acceleration in the pace of rate cuts suggest that you will bring forward the timing for when you will end QT?
You want to say that?
Yeah, I think, Randy, our position on QT really hasn't changed. We've always said it'll operate in the background and it'll support our rate cuts. I actually think the way to interpret the decision we made today is about normalization. I think the way the governor just characterized our discussion was really a build of confidence in the direction that both the economy and inflation's moving. Back when we started cutting in June, we talked a lot about push-pull forces, and I think the council was worried that those forces pushing inflation up would would win out. They would be stronger than the ones pulling them down. We've had the benefit of time and more data and more discussion. And I think, the cut that we made today really reflects that increasing confidence that we're heading in the right direction. So, and QT is also heading in the right direction. We don't plan any immediate changes to it.
Okay, let's go to Greg Quinn from Market News, please.
Good morning. I'm already seeing some economists interpreting the jump to 50 from the 3 moves of 25 as a sign that the real concern is undershooting of the inflation target. Can you tell me what's wrong with that kind of interpretation of what you're doing today?
Well, Greg, as I indicated, for a number of reasons, we thought it was appropriate to take a bigger step today. That's what we've done. We've continued to indicate we expect there will be further cuts in our policy rate if things evolve broadly as we've expected. In terms of, the decisions we've taken recently and where we're headed. I mean, we started cutting our policy rate in June. We've cut it at successive meetings. We've had 4 cuts, taken the policy rate from 5 down to 3 3/4. As I've indicated, we expect that if things evolve as we're forecasting, there are more cuts to come. If you look at our forecast, it has inflation staying close to the middle of the 1% to 3% range. As I indicated, yes, there are going to be some monthly fluctuations. We're not literally going to hit 2% every month, but our own forecast has it staying close to the middle of the range. And at the same time, with lower inflation, with lower interest rates, the stage is set for growth to pick up. Our forecast has growth picking up gradually, 2.1% next year, 2.3% in 2026. So it's a pretty good looking story. Lower inflation, lower interest rates, a pickup in growth. There are some risks around that outlook, and we certainly highlight those. I think that the biggest downside risk we see is that it could take longer than we think for lower interest rates to pass through to stronger household spending. On the upside, though, we know housing is very interest sensitive. As we lower rates, we've got a pickup in housing in our forecast. That could happen faster, could be bigger than we are expecting. We've also got wage growth, which is still elevated relative to productivity. We think that will gradually come down, but if wage growth stays up relative to productivity or productivity doesn't pick up, there could be more cost pressures in the economy. Look, we think the risks around our outlook are reasonably balanced, but we're going to be watching those risks closely, and we'll be seeing how things develop, and if things break one way or the other, I expect that'll feed into our decisions.
Okay, next on my list, I have Jordan Gowling from the Financial Post. Go ahead, please, Jordan.
Yeah, I wanted to ask about housing. You cited it as a main sort of risk to the outlook. You cited new mortgage rules introduced by the federal government, pent-up demand, and lower interest rates. Can you expand on how you're weighing those worries in your deliberations?
As you know, we've been watching housing closely. It's one of the most interest-sensitive parts of the economy, so it's always a sort of a leading, an area of the economy that responds quicker to changes in interest rates. In our forecast, we do have a pickup in housing. It is possible that the combination of lower interest rates and changes in mortgage rules could mean that pickup happens sooner or faster or stronger than we expect. It's also possible people will look at the direction of interest rates and sort of stay on the sidelines a bit longer and wait for rates to come down more, and we don't see that pickup happen as fast or as strong as we're anticipating. So we'll keep watching it closely.
Okay, next I'm going to call on Najoud Al-Malise from the Canadian Press, please.
Hi, Governor. After the last rate cut, you signaled that the bank's ready to cut faster if warranted, and now you have. I'm wondering how likely you think it is that you'll have to cut by another 50 basis points in December.
Look, I'm not gonna handicap the next move. I think we've been pretty clear on the direction. And I think we've been pretty clear that the timing and the pace is going to depend on how the data evolves, what we see, and what we think is needed when we get there. We're going to get a fair amount of information between now and December, and we're going to take our December decision in December.
Okay, next is Alicia Sikirska from Yahoo Finance.
Thank you for taking our questions. While inflation has gone back to target, Canadians aren't necessarily cheering that fact, just given how high prices are. Do you expect this fourth cut to make a difference in terms of how Canadians are experiencing the economy versus what we keep telling them about the data?
Well, look, first of all, thank you for the question. It has been a long road back from the high inflation we experienced coming out of the pandemic. And yeah, it's been tough. High inflation, high interest rates have been painful for Canadians. Now we're back to low inflation. Interest rates are coming down, and with today's 50 basis point cut, that is setting the stage for growth to pick up. So, yeah, it's been a long fight against inflation, but it's worked. And the outlook, we're coming out the other side, and I think Canadians can breathe a sigh of relief. I think it's a good news story. The second thing I would highlight, though, is we've got inflation down. We're back to low inflation. Now we need to keep it there. And our focus is very much now on maintaining low inflation, keeping inflation close to target. Price stability is low, stable inflation. We're back to low inflation. Now we need low and stable inflation. And when I say we need to stick the landing, that's what it means. That's sticking the landing.
Right, next we'll go to Paul Vieira from the Wall Street Journal. Go ahead, please, Paul.
Governor, with inflation coming back to 2% much earlier than the bank expected, is it fair to say that perhaps officials underestimated the underlying weakness in the Canadian economy?
Paul, inflation has come down a little faster than we expected. But if you look at our forecasts over really the last year, things have evolved broadly in line with what we expected. We are pleased to see that inflation has come back a little quicker. Reflecting that, we've taken a 50 basis point cut today. That should help bring demand and supply back into balance in the economy. But if you look over the last year, really, the main message is it hasn't been easy. Higher interest rates have been tough on Canadians, but monetary policy has worked, and it's worked largely as we've expected. And since June, we've been cutting our policy rate. We're coming out the other side. And as I said, our focus really very much now is on sticking the landing, keeping inflation where it is.
Right, we'll now go to Kevin Carmichael from The Logic, please.
Good morning. You're sticking with another, sort of the meeting-to-meeting cadence. I wondered if you could discuss about why it's so difficult for not only the Bank of Canada, but central banks generally to lay out a clearer trajectory for rates over the next couple of years, and discuss the extent to which that might be weighing on investment decisions going forward, given the lack of clarity around monetary policy.
Well, Kevin, we actually have been very clear about the direction of policy rate. Since June, since we cut in June, we've been indicating that if things continue to evolve broadly in line with our forecasts, we anticipate cutting our policy rate further, and that's what we've been doing. So I do think we've been clear about the direction. When it gets down to exactly what you're going to do at each meeting, is it 50, is it 25? That is something that is going to depend on how the data evolves. And why is it difficult? Well, it's difficult because we don't know the future. If we knew the future, it would be easier. But of course, none of us do. We're discovering how the economy is evolving, like everybody else, and based on the best available information we have at the time, we'll take our decisions. But we have really been very clear about the direction, and I think we're being very transparent about the fact that, we're going to take each decision at the time based on the best available information. By putting out our forecast, it does allow market participants, Canadians, to assess, are things coming out in line with what we thought? Are they coming in below? Are they coming out stronger? And you can see that. It will, as that happens, you can see the probabilities in the market as to what we will do start to shift. And I think that is part of the value of putting out our forecast. It tells people what we think, and they can evaluate the data just as we do relative to that forecast.
Okay, our final question here in Ottawa is going to be from Mike Lecouture of CTV, please.
I just wanted to pick up on what one of my colleagues is mentioning and how you had said Canadians can breathe a sigh of relief, but a lot of Canadians don't feel that, even though the numbers are bearing it out, that we are doing better. Canadians aren't feeling that. How do you bridge that gap?
Look, we're very aware of that. We certainly survey Canadians' plans, spending plans, expectations regularly. And yes, you can see it in our own consumer survey. There is a lot of hesitancy. I think the message today is that with inflation down, Canadians they don't have to worry as much about big changes in their cost of living. They've got lots of things to worry about, but our commitment, we've got inflation down. It has been a long road. We're committed to keeping inflation close to the 2% target, and we're going to use our interest rate to deliver on that. And with inflation staying close to 2%, Canadians don't have to worry about big changes in their cost of living. Yes, they got lots of other things to worry about. This is one less thing to worry about.
I think maybe I'll add to what the governor just said. I mean, I think one of the things that Canadians are feeling is that prices have increased. There's been a level shift up. So inflation is a measure of how fast prices are increasing. But I think what Canadians feel is life's more expensive now than it was 2 years ago. And so, it's really a good news story that inflation has come back. It means that prices aren't going to keep going up. But every time you go to the grocery store, I'm sure you're feeling that fact that prices have come up. And I mean, in particular, through this period, the things that you really can't avoid have seen a particular increase. So, food, rent, housing, stuff like that. So, I mean, I think that's what Canadians are feeling. It's going to take a while for that stability to sort of sink back in, and for Canadians to really feel comfortable and not have that worry that they've lived with for the last 2 years. So we get that. There's also been wage increases that have helped offset that increase in cost, but not everybody has seen a wage increase, and even those who've seen wage increases, it's maybe not been enough to offset that increase in the cost of living. So we get that inflation is different than a level shift up in prices. The thing that we can control and the thing that we're determined to control for Canadians is inflation, so that they can stop worrying about future price increases.
Okay, we're going to go to the phones now. I've got 3 folks on the line. I'll just remind you to come off mute only to ask your question, and then go back on mute as soon as you finish so everybody can hear the response. And first we'll go to Max Sato from Mace News, please.
Thank you, Paul. Governor, how do you evaluate the current inflation climate compared to recent years when inflation was rather under control. For example, February 2021, I think the current 1.6 was the lowest since then, which was 1.1. And also going back to maybe March 2020, was down to 0.9 from 2.2. Do you think people are more sensitive to a possible uptick and allow it to happen when prices are higher, reacting to any signs of another, for example, supply chain breakdown?
Well, it's a little bit of a difficult question to answer because, I mean, Canadians have, a range of experiences. I think coming back to what we've been talking about, Canadians have been through a lot in the last few years. Pandemic, high inflation, high interest rates. Okay, pandemic's long gone. It did have a long, it has cast a long shadow. We are coming out of that. Inflation's back down. I think the inflation climate is much more back to normal. I mean, if you look at our, headline inflation around 2%, core, our two measures of core a little below 2.5%. If you look at the distribution of price changes, it's much more normal than it was. That doesn't mean everything is normal. There's still some fallout, and I think having come through this period of high inflation, yes, I mean that has impacted Canadians. Canadians are still living with the higher prices at the grocery store in particular. They're living with higher rents. But with inflation now low and with our commitment to keep it low, we're getting back to a much more normal situation. And yeah, I think that is going to be some relief for Canadians. It's going to take some time. As I said, price stability is low, stable inflation. We've got back to low. Now we need to deliver on stable.
Okay, now we'll go to Rob McClister from Mortgage Logic News. Go ahead, please, Rob.
Good morning. I'm curious how much the bank factors in bond market expectations. So, for example, yields are up today despite the 50 basis point rate cut. Seems the market doesn't really believe we need much more rate cuts than are already priced in. So, if yields were to start marching higher, maybe with U.S. yields going up, how much would that market outlook affect your expectation of how much more easing we need here in Canada?
Well, these hypothetical questions are always a little hard to answer. Look, obviously, we look at broad financial conditions because that has an influence on the strength of demand in the economy. What we control, which is the one-day money, the overnight rate, that feeds through to financial conditions, but it is certainly not the only thing that is influencing financial conditions. As you highlighted, Canada's financial system is very integrated with the global financial system. It's very integrated with U.S. markets. So all those things are also going to affect financial conditions in Canada. And yes, we look at financial conditions when we're taking our decisions because, people don't fund their mortgage at our overnight rate. They fund their mortgage at their mortgage rate, which could be a variable rate. It could be a 5-year rate. If you're a business, you're not borrowing money overnight at the Bank of Canada rate. You're paying the prime rate. You're probably borrowing for a few years. So yes, we do look at the rates that businesses and households are actually facing. That's a key ingredient to broader financial conditions, and that's something we look at when we take our interest rate decisions.
Et si je comprends bien, Monsieur Gérard Filion de Radio-Canada est maintenant avec nous sur le téléphone. Alors, Monsieur Filion, avez-vous une question?
Oui, absolument. Vous évoquez, M. Macklem, bonjour d'abord, vous évoquez dans le rapport de la politique monétaire que les perspectives économiques sont soumises à une incertitude géopolitique accrue, notamment les élections aux États-Unis. Et il y a beaucoup d'économistes qui se sont inquiétés récemment de l'impact des tarifs douaniers qui pourraient être imposés sur les importations aux États-Unis, de l'impact que ça pourrait avoir sur l'économie canadienne et sur l'inflation aux États-Unis et en général. Quel serait l'impact que ça pourrait avoir sur la politique monétaire au Canada?
Oui, comme vous avez souligné, il y a des incertitudes géopolitiques. Oui, possibilité des tarifs. Il y a des conflits autour du monde. Il y a des élections importantes. Donc, oui, ça crée des risques à deux côtés. Si ces risques matérialisent, s'il y a des changements de politique, on va les pris en compte, on va réviser nos prévisions et ça peut influencer nos décisions. À ce point-ci, j'ai pas d'analyse de différentes politiques. Les politiques ne sont pas déterminées, ils ne sont pas annoncés, mais oui, si les politiques changent, on va regarder les implications pour le Canada.
Okay, and with that will conclude today's press conference. Thank you, Governor, Senior Deputy Governor, and thanks to all of you for joining us today.
Thank you.
Thank you.